Good to be here.
Hey, we were just talking with our Stuart Paul about Kevin Warsh's past support of a new accord between the Treasury and the Fed, and this has to do with the balance sheet, which sounds like increased cooperation. We know in the past that Kevin Warsh has wanted the Fed to shrink its balance sheet, so we're trying to make sense of what it is. And then we just talked about the Chinese regulators advising their financial institutions to rein in the holding of U.S. government bonds. Are Treasuries undergoing a reboot, in your view, on the world stage when it comes to, the United States being kind of a sure thing, if you will, in the financial world? And if so, what are the implications of that?
I mean, look, I don't know if there's any real alternative for a lot of these, countries to invest their reserves.
Because of the size and the liquidity, right?
Exactly.
Of the U.S., like hands down.
And look, there is a risk out there in the long end of the government bond curves, I think, but that's globally. We've seen that happen in UK gilts. We've seen that happen in German bonds. We've seen it happen in Japanese JGBs. So I don't think really concern about the impact of fiscal spending on the long end of the yield curve is unique to the U.S., nor is it something that's kind of snuck up on people. But it is a risk. And if you look at what is triggered those kind of events in other countries, it's generally been things related to fiscal policy, tax cuts, things of that nature. So it's something that's on our radar. It's probably been on our radar since about last July, when all of those 30-year bonds globally got above 3%. As an equity guy, I'm going to let the bond markets tell me, when and if this becomes a risk. But for now...
But the equity guys keep a watch on the bond market.
we do, but I would say if an equity guy knows when the bond auction is, you're in trouble. But big picture, in this case, I think, we have not seen the long end of the curve move significantly. We haven't seen bond volatility increase materially either. Sure. So for now, people seem pretty comfortable with things.
Well, speaking of the equity side of things, you were plenty busy last week with the rotation that we saw, the volatility that we saw, the moves down, then the moves up, a week that sort of ended really close to where it started, but a lot happened in between with some big moves lower when it comes to companies like software. What is your view on where to be optimistic right now and where to stay away from?
Yeah, I mean, so we're still pretty positive U.S. equity risks in general. We've been pretty bullish on the cyclical parts of the equity market since the beginning of the year. I think if you took a little bit of a step back, though, you'd see that this quote-unquote rotation sort of out of tech and growth and into value and cyclicals actually started back in November. It's not a new phenomenon. What happened last week is the moves accelerated and it got quite volatile. And I think that impacted the way that folks manage risk. And it's also, to be honest with you, a pretty simple math question, right? If you take the Mag 7 plus Broadcom and a few others, you pretty quickly get close to about 50% of S&P market cap.
Right.
So when you're selling those stocks, you have to find a home for them. And I think just the absolute size of the moves is really what concerned people last week, rather than a change to like the underlying U.S. equity outlook. I mean, U.S. GDP, according to the Fed, is tracking kind of mid 4% range. Our economic surprise index is kind of off the chart. Earnings were solid. You're expecting some good tax refunds coming up. So the sort of fundamental underpinnings of the market look pretty good. What you're going through is some indigestion after 2 years of buying tech and growth stocks. You're now kind of repositioning not whether you want to own U.S. equities, but how. And that process has been a little bumpy, to say the least.
Well, we talked, too, about the overperformance or performance of small caps last week. They were up about 2.2%, certainly outperforming the large cap indices. The other thing is, if you look at the equal weight S&P, it is easily outperforming the S&P 500, 5.5% year to date for the equal weight to just under 2% for the widely quoted S&P 500. So again, that plays into what you're saying, that we're seeing money go elsewhere. But what's to stop the money going back to big cap tech or those hyperscalers? Because it feels like the last 2 or 3 years, everyone's like, no, time to diversify. And yet, that's where the overperformance has been, or outperformance.
I mean, I think back in sort of October and November earnings season, you started to see a little bit of a change in this reaction function. Meta back then was the key one, where they announced this very large capex spending program, and the stock sold off.
Right.
And that was probably the first time in the last couple of years where a company had been punished for spending more on AI. And look, lo and behold, this quarter we saw that repeat with a number of companies. So,
but Meta did well, right, off of their earnings, because they're showing the ROI on this AI spend.
They are, and that's the key, right? This capex spending is undergoing an audit or some other form of very invasive examination. But Microsoft and Amazon were both kind of punished for more capex spending this quarter. So I think what you're really seeing is within the tech trade, the shift has moved kind of away from the spenders and to the beneficiaries of that spending. We like power generation and the AI data center build out as the way to express that. And then more broadly, to your point, you're also getting a little bit of a rotation out of growth into these cyclicals. So again, these things aren't necessarily negative for the market collectively, but they do cause a lot of pain in some positions that people have had in their portfolios for 24 months minimum.
Alphabet embarks on a global bond spree to fund record spending, borrowing far and wide to finance unprecedented spending plan on its AI ambitions. $20 billion, a U.S. dollar bond offering on Monday, more than $15 billion than initially expected. Is this a signal of something?
I mean, it's a
same thing you're just talking about.
It's a signal that they have a lot of spending to do. I think
They also have a lot of money.
They do, but Amazon though looks like negative free cash flow after their announcement. So I think what folks are doing is you can generally carve out the Mag 7 and say their balance sheets are so big and strong that they can sustain the spending. They're all AA rated or better. You take a step, even a slight step down in credit rating to, let's say, an Oracle that's BBB,
right?
And that examination is a little more harsh. So I think what you're seeing from Google, frankly, is look, they're viewed as the current winner in the AI trade. Now, clearly, those winners are changing quarter to quarter. So I think folks are maybe a little more comfortable with them spending, because to your point, they have the ROI, they currently have the best AI model. If you can demonstrate acceptable return on the investment, the markets are okay with this. If it looks like it's going to be ROE destructive, then right now you're getting punished for that a little bit. And I wouldn't expect that to change as this year goes on. I mean, there's a higher bar right now for what you're going to spend.